The global landscape on January 30, 2026, represents a critical juncture where the convergence of assertive U.S. executive diplomacy, a return to monetary orthodoxy, and the structural fragmentation of global supply chains has created a volatile yet transformative market environment. The nomination of a new Federal Reserve Chair, coupled with an aggressive reorganization of the international semiconductor trade under the Pax Silica initiative, suggests that the age of competition, identified by global risk assessments, is now entering its most intense phase. This report analyzes the cascading effects of these developments on global indices, commodities, and the geopolitical balance of power, synthesized through the lens of data-driven strategic intelligence. What happened? The return of a hawk. The announcement that the White House intends to nominate Kevin Warsh as the next chair of the Federal Reserve has triggered an immediate and sharp repricing across global bond and equity markets. This move signals a definitive departure from the accommodative stance of the previous decade and a return to what many analysts describe as monetary orthodoxy. Warsh, whose tenure as a Fed governor from 2006 to 2011 was marked by a persistent focus on inflation risks and market-driven discipline, is viewed by the current administration as the ideal candidate to stabilize the dollar amidst rising fiscal expenditures and geopolitical uncertainty. How and why? The mechanism of repricing. The market response on January 30th has been characterized by a risk-off flight, primarily driven by expectations that a Warsh-led Fed will be less inclined to provide liquidity support during market downturns. The emphasis on the Fed's dual mandate, with a specific lean toward labor market dynamics and inflation control rather than growth stimulation, has led to a contraction in Nasdaq 100 contracts by 1.3% and a 1% decline in S&P 500 futures. Investors are dialing back bets on policy easing, recognizing that Warsh's historical focus on inflation risks suggests a higher-for-longer interest rate environment. Who is involved? The White House, seeking to instill market discipline and strengthen the U.S. dollar. Kevin Warsh, the nominee, known for his orthodox views on monetary policy and focus on the labor market. Global investors, currently liquidating tech-heavy positions in anticipation of tighter financial conditions. Stock market impact. The rise in the 10-year Treasury yield to 4.27% reflects the anticipation of this shift. For the technology sector, where valuations are highly sensitive to discount rates, the impact has been severe. Microsoft, for instance, saw its shares crater by over 11% following an earnings report that highlighted ballooning capital expenditures in AI infrastructure, a cost center that becomes increasingly burdensome under tighter monetary conditions. Long-term, the nomination suggests a structural shift toward a stronger U.S. dollar and a more disciplined fiscal monetary coordination. This may lead to a sustained period of lower equity multiples for growth stocks, but could stabilize the dollar as a global reserve asset. Short-term, sentiment is decidedly bearish as traders adjust to the loss of the Fed put. The focus remains on the Friday announcement of the PIC and the subsequent Senate confirmation hearings. One of the most dramatic events of early 2026 has been the extreme volatility in precious metals. After a historic rally throughout 2025, silver and gold have entered a period of sharp correction. Silver, which had surged past $120 per ounce on January 29th, fell 11% on January 30th to trade near $107. Gold followed suit, retreating from its record high of $5,600 to trade around $4,972, a one-day slide of approximately 7.5%. The rally in silver was not merely speculative, it was driven by a fundamental supply-demand imbalance. Silver has been upgraded from a commodity to a national strategic asset. China, the global leader in photovoltaics, PV, and electric vehicles, EVs, has reclassified silver as a strategic material, restricting exports to ensure its own industrial supply. This move fragmented the global market, contributing to the physical run on Wall Street, where investors scrambled for deliverable metal as paper contracts failed to provide security. For decades, silver prices were controlled by futures traders on the COMEX and LBMA, where paper volume reached a 356-to-1 ratio against physical stocks. In early 2026, this assumption failed as institutional investors demanded physical delivery, draining inventories in London and New York. However, the prospect of a hawkish Fed under Kevin Warsh acted as a circuit breaker, as rising real interest rates reduced the appeal of non-yielding assets. Mining stocks and commodity-linked ETFs have seen massive sell-offs. The decline in gold and silver has also weighed on the broader materials sector, though energy markets remain somewhat buoyed by Middle Eastern tensions. Long-term implications and short-term sentiment. Long-term. Despite the current correction, the structural deficit in silver is expected to persist through 2026 and beyond. The demand from solar modules, 15-20 grams per module, and EVs, 1 to 3 ounces per vehicle, remains non-discretionary, suggesting that prices will eventually find a high floor once the monetary shock subsides. Short-term, fear is dominant. High-frequency trading and stop-loss orders are creating cascading selling pressure. In a black swan geopolitical event, the United States captured Venezuelan President Nicolás Maduro in January 2026. This action, supported by the UK, led to the interception of the vessel Bella 1, renamed Marinera, which was part of a shadow fleet carrying sanctioned oil for Venezuela, Russia, and Iran. Simultaneously, President Trump issued a stern ultimatum to Iran: agree to a nuclear deal immediately or face potential U.S. military strikes. The capture of Maduro and the dismantling of the shadow fleet are strategic blows to Iran's economy. Iran and Venezuela have long established ties used to offset international sanctions through the trade of oil and drones. The loss of these illicit revenue streams coincides with massive internal instability in Iran, where protests initially sparked by a 40% devaluation of the rial have spread to all 31 provinces. The January 2026 protests began in Tehran's Grand Bazaar, the first time since 1979 that the bazaar acted as the catalyst for unrest. The Iranian government's 2026 budget exacerbated grievances by increasing security spending by 150% while offering wage increases far below the 60% inflation rate. The regime's response has been brutal, with reports suggesting at least 30,000 people were killed in the first 48 hours of a crackdown that began on January 8th. Who is involved? The Trump administration, issuing ultimatums and deploying the USS Abraham Lincoln to the Middle East. The Iranian regime, facing internal revolution and the loss of regional proxies, Hamas, Hezbollah, who are being pressured to disarm. Israel, increasing war readiness amid the instability, fearing a desperate strike from Tehran. Stock market impact. The threat of military conflict in the Strait of Hormuz has kept Brent crude futures volatile. While broader risk-off sentiment led to a retreat on January 30th, Brent remains near the $70 resistance level after jumping 2.45% earlier in the week. Long-term, the weakening of the Iran-Venezuela-Russia shadow economy could lead to a significant realignment of global oil flows and a reduction in the financing of non-state actors in the Middle East. Short-term, extreme tension. The market is pricing in a 69% chance of a U.S. government shutdown and watching for any signs of direct U.S.-Iran kinetic engagement. The Ukraine conflict, the Anchorage formula, and the Abu Dhabi talks, a fragile winter truce. As Ukraine endures its harshest winter in a decade, President Trump announced on January 29th that Vladimir Putin had agreed to a one-week halt on strikes against Ukraine's energy infrastructure. This truce follows a personal appeal from Trump to prevent millions from freezing as temperatures hit 30 degrees C. Ukrainian President Zelensky welcomed the statement but remains skeptical, noting that Russian drone strikes have continued despite the claim. The road to the February 1st summit. The truce is a precursor to the trilateral talks scheduled for February 1st in Abu Dhabi, involving the US, Russia, and Ukraine. These negotiations are based on the Anchorage formula, an agreement reached by Trump and Putin in August 2025 to outline parameters for a settlement. The UAE has emerged as a critical global connector, having already facilitated 17 prisoner exchanges and hosting these high-stakes diplomatic bridges. The asymmetry of decline data suggests that Russia is paying an extraordinary price for minimal battlefield gains. Since 2022, Russian forces have suffered nearly 1.2 million casualties. With manufacturing declining and growth at a meager 0.6% in 2025, Moscow is described as a structurally outmatched power in the new U.S. national defense strategy. This economic and military strain is the primary driver behind Putin's willingness to engage in the anchorage process, even as he publicly maintains hardline territorial demands. Who is involved? The UAE, acting as the trusted mediator in Abu Dhabi. Donald Trump, driving the anchorage formula and shuttling envoys like Steve Witkoff. Volodymyr Zelensky, pushing for 2027 EU membership as an economic security guarantee. Stock market impact. Global markets are cautiously optimistic about a de-escalation, but the territorial issue remains a fundamental roadblock. European stocks were mostly higher on January 30th, with the Stoxx 600 climbing 0.2%, partially reflecting relief over the energy truce. Long-term implications and short-term sentiment. Long-term, the push for Ukraine to join the EU in 2027 and the finalization of U.S. security guarantees, 100% ready according to Zelensky, point toward a frozen conflict model similar to the Korean Peninsula. Short-term, neutral to bullish on de-escalation news, but highly sensitive to any breach of the energy truce. Pax Silica, the new world order for semiconductors. India joins the Strategic Silicon Alliance. In a move that officially shifts the balance of technological power, the U.S. confirmed on January 30th that India will join Pax Silica in February 2026. Pax Silica is a U.S.-led strategic initiative launched in December 2025 to secure the global AI and semiconductor supply chain and reduce dependency on non-aligned nations, specifically China. India joins a coalition that already includes Japan, Israel, Australia, Singapore, South Korea, the UK, Qatar, and the UAE. The architecture of the 21st century Pax Silica is built on the principle that economic security and national security are inseparable. The initiative aims to align export controls, investment screening, and R&D subsidies among member nations. By including India, the coalition gains access to a massive software engineering talent pool and an alternative production hub to counter China's dominance in critical minerals and advanced manufacturing. India's semiconductor milestone. India's entry into Pax Silica coincides with the commencement of commercial semiconductor manufacturing in the country. 4 major plants, Micron, CG Power, Kaynes Technology, and Tata Electronics, are set to begin commercial production in 2026. This transition from pilot to commercial scale marks a historic milestone for India's self-reliance. Stock market impact. The India-EU FTA and the Pax Silica entry have sparked a rally in Indian IT services and electronics manufacturing. While the broader Sensex fell 0.3% on January 30th due to FII outflows, the long-term thematic growth in the silicon supply chain remains a top-tier investor favorite. Long-term, the restructuring of the global chip supply chain will create permanent choke points in high-end equipment like EUV lithography. India is positioning itself as the Indian version of Qualcomm or Intel, focusing on design and high-end fabrication. Short-term, bullish on the Pax Silica theme, investors are looking for entry points in Indian and U.S. chip equipment manufacturers. Regional analysis, India, China, and the Indo-Pacific balance. The rupee's record low versus stellar fundamentals. On January 30th, the Indian rupee hit an all-time low of 92.02 against the US dollar. This occurred despite the Economic Survey 2025-26 projecting India's GDP growth at 6.8–7.2% for FY27 and reporting that inflation has been tamed. The disconnect is driven by the global WARSH pivot and the resulting surge in the US dollar index. The U.S.-China Economic Commission, hearing the U.S.-China Economic and Security Review Commission, announced a hearing for February 17, 2026, titled India, China, and the Balance of Power in the Indo-Pacific. This hearing will explore India's role as a counterbalance to Beijing, just 6 weeks before President Trump is scheduled to visit China in April 2026. Despite strained coordination in 2025, the U.S. is doubling down on its strategic partnership with New Delhi to secure maritime access in the Indian Ocean. Australia and the trade of surprises. In the Southern Hemisphere, Australian farmers are being warned to prepare for geopolitical surprises as Trump's trade policies continue to shape markets. While 10% tariffs on Australian beef were recently abolished, China has introduced new beef import quotas, creating a competitive squeeze between Australian and Brazilian producers in the US and Chinese markets. Stock market impact. The Indian rupee's weakness has led to a negative trend in domestic equities, with the Sensex declining 296 points on January 30th. However, the IT sector is expected to benefit from the India-EU FTA, which accelerates market access and digital trade rules. Long-term implications and short-term sentiment. Long-term, India is on track to become the second-largest exporter of electronics, significantly reducing its 100B+ chip import bill. The graded opening of the Indian economy to China, contingent on Beijing's concessions, suggests a new era of reciprocal geoeconomics. Short-term, bearish on the currency, rupee, but bullish on the industrial tech manufacturing thematic. The WARSH effect has fundamentally altered the discount rate for all future earnings. As the dollar heads for its worst month since June, the intraday surge of 0.5% in the Bloomberg Dollar Spot Index suggests the bottom is in for the greenback. Short-term sentiment. Controlled panic. The short-term sentiment is characterized by controlled panic. The rapid-fire nature of the week's events, the silver collapse, the Maduro capture, and the Fed pivot, has left algorithms and retail traders in a state of high-speed recalibration. Investors are moving to cash and short-term treasuries while they await the official confirmation of the Fed nominee and the results of the Abu Dhabi peace talks. Long-term implications. The fragmented renaissance. As a researcher in geoeconomics, my view is that we are entering a fragmented renaissance. While global trade as we knew it is dead, new alliances like Pax Silica are creating high-value corridors of innovation. Monetary discipline. The Fed's move to orthodoxy under Warsh will likely tame the inflation that defined the 2022-2025 period, but at the cost of the infinite growth era for big tech. Resource sovereignty. Silver and semiconductors are the new oil. Countries that control the physical supply or the fabrication choke points, like India and the Pax Silica members, will hold the geopolitical leverage of the 2030s. The end of the shadow fleet. The capture of Maduro and the pressure on Iran suggest that the age of evasion is ending. Sanctions are being replaced by physical interdiction, forcing rogue states back to the negotiating table in places like Abu Dhabi. Agricultural volatility. Food security is now a Tier 1 national security issue. Trade policies will be erratic and surprising, requiring farmers and agribusiness to be as strategically literate as hedge fund managers. The data actually tells us that while the paper game is collapsing in the silver market, the physical reality of the AI and green energy revolution is only accelerating. For the savvy investor, this correction is the great filter, separating speculative hype from the structural winners of the Pax Silica era. Stay focused on the yields, keep an eye on the Abu Dhabi headlines on February 1st, and watch for the formal invitation of India into the Silicon inner circle. The architecture of the 21st century is being built right now.